Hey investors, so going to look at the global economic indicators and global demand indicators for November 2022. If you go over to boombustinvest.com and go to financial crash and in the indicators page, everything that I'll go through here you can just check out for yourself. So we're just looking at some of the main sort of measurements and indicators for demand, global economic demand. Just to see where our globally diversified funds and retirement funds might be heading. So it's more of a forward-looking view, really. So looking at things like the PMIs, we're looking at unemployment. So you can come along and check out these links here if you want to. So I'm just going to go through and just sort of summarize some of the main ones here, so we can just get an overview of, like, where we're heading, where we might be heading in the near term. So starting off then at the Federal Reserve database site, obviously now the central banks are tightening, so we're seeing the economic monetary supply, M2 monetary economic indicator, come down. So we all know about that anyway, and we see how much money was injected into the system by the central banks after the pandemic. So we know all about that. So yes, we're seeing that continue, and the velocity of money, which is kind of more important, really. So this is a measurement of really economic activity. This is all US, but we need to be concerned with our global funds will have a significant allocation to the US, biggest stock market and economy in the world. So that's why we need to be kind of aware of what's happening there. And what we've seen recently is a fairly decent uptick, actually. So despite the doom and gloom for the US, maybe it is heading into a recession, but this is actually sort of fairly good sign here that we are seeing a pickup in economic activity. So we'll see if that continues, but that's certainly positive, that particular uptick here that we're seeing from Q1 up to Q3. So we'll see. That'll probably continue for Q4. If we start seeing a recession, we could see that heading back down again. So that's what we're going to sort of keep an eye out for in 2024. And then related to the velocity of money is the total monetary base. So it's like the sort of liquid or available money in the system. So we see that heading up as well. So that sort of confirms that we're seeing more liquidity and economic activity. So it's good for the US. So it's not all doom and gloom. And then the central bank balance sheets for the UK. So this is this is trading economics here. So over the longer term, this is going back about 10 years. So it's the same story really playing out across the globe, with all the central banks injecting a lot of money into the financial system in each country, and then sort of starting to withdraw it as we sort of get over the worst of the pandemic and whatnot. So same picture for the UK, maybe not as pronounced as the US. And then we're starting to get into the purchasing managers index, which is the kind of main demand measure that's watched for the global economy. So there's the manufacturing PMI and the services PMI. But the manufacturing, I mean, either of those will be a good sort of measure. Manufacturing is quite a good sort of leading indicator, actually, as to where the global economy is going. So the US PMI, manufacturing PMI, so this is the longer term chart. As we can see, in 2020 it dropped off a cliff, and we're at quite a low point here. This is like below 50 is in contraction. So you see the US is going into contraction here in terms of the demand, and therefore not a good sign for globally diversified funds, because if the US goes down, as I say, everywhere goes down. So yeah, it's going back to 2012, we're below we're kind of way below where we've been in the past 10 years. So as we'll see, we'll go into a little bit more detail, but this is actually the only negative in terms of like the sort of global indicators, economic indicators, and demand indicators, like unemployment as well, which take a look at. This is actually only negative. So this could be more of a forward-looking indicator. So this is a concern, despite the other indicators sort of not really indicating any sort of really bad problems. This could turn into a bad problem, so we need to be sort of wary of this one. So as we can see here, the manufacturing PMI went down from 50, which is just about in expansion territory. Anything below 50 means that the measure or economy is declining. So that's quite a big decline. Similarly, for services PMI, that was already in decline, and it's going further in decline, 46. That's pretty low. Anything below 45, it's getting towards panic stations, because if I just show you this graph here, so this is quite hard to see, but when you go below 45, for example, this is Eurozone composite PMI, so manufacturers and services. This is the great financial crisis, which is actually a lot worse than the dot-com bust here. So the dot-com bust here, we're getting down to 45. Great financial crisis, we went way below 45 into and the shaded area is GDP. More towards 35 currently. So then we're kind of here. If we keep going down further below 45, this is this is great financial crisis territory that we'll be entering in terms of the PMI demand indicator. So we just need to keep an eye on it. If it keeps going down, then it's going to be quite bad for stock markets. So we'll keep an eye on that one. So the PMI page, the main sort of S&P Global PMI page. You can tell just going to this page, you can see on the ticker going across where most of the countries and regions are between 45 and 50. See, the UK is 46.5. That's in November, so it's actually a 2-month high. It's still in contraction, not that far above 45. US 47, so 30-month low. So the composite for the US there is 46. So it's all in contraction territory. The Eurozone there is 47. Japan's 48, 49. So yeah, if that continues, it's kind of like not a good time to Brazil down here at 44. If this Czech Republic 41. So if these figures continue to go down, it's the world one that we want to take a look at. But if these figures continue to go down, then it's not. There we go. Global manufacturing is 48, contracting. So yeah, if these keep going down, then it's not good for stock markets. So we have to keep an eye on that one. Again, in the press releases, you can get like day-by-day accounts of the latest kind of information that's come out. So yesterday was December 5th. So let's go with what can we take a look at? Let's go with the global Eurozone composite. So that's manufacturing and services, and we see, here's the great financial crisis. this was, I think, like the sovereign debt crisis, so things were kind of getting pretty bad there. GDP went down, and as we see, we're down kind of 47, 48 maybe. Obviously that was COVID, so pretty much ignore that. It's a complete distortion, but if this continues down in this great financial crisis shape, then that's not going to be good for the Eurozone. So keep your eye on that one. Oxford Economics is a leading independent economic advisory firm, so it's very well respected. So I'm just like taking a few different sources here, not just focusing on one source, and just sort of reading the headlines here. So you can come along and read this if you want. But global world economic prospects, global economy to fall into a recession. They're also covering things like the housing market crash. So we've got this idea here that that everything bubble, all of the assets have been inflated by central banks by keeping rates too low and injecting copious amounts of money into financial markets, which has just pumped everything up. And now we're seeing that unwind. So you can come along and sort of like read some of these supply side problems exacerbating economic difficulties in the UK. So we've still got some supply side issues in the UK. I think less so in the US now. But at the end, there is a report on the outlook, what they expect. It's a forecast, but they do expect growth in 2023 despite a recession. Again, that's just their best guess. Despite being a respected name, that's just a guess. It could be a lot worse if we enter into a recession. So you can come along and check that one out as well. So just a couple of more measures here before we take a look at unemployment. So copper, which is a sort of good barometer of global economic demand. This is the yearly chart here. So you see it's actually not bad. It's not continuing to slump. If anything, it's going sort of like trending up slightly. So global economic demand is increasing for copper, which is a good sign for the global economy in general. Over the 10-year, again, so I mean it went up a long way from 2019. So from the pandemic, it's been pushed up. So it's higher than it was prior to the pandemic. Again, this is a good sign. The Baltic Exchange Dry Index, so we see over the longer term here, that's kind of normalized as well. It's come back from very high levels in the sort of run up to 2022, and then it's come back down to sort of normalized levels going back 5 years. So again, this is another positive sign. We're not seeing kind of distortions in shipping costs globally. Again, it's a positive sign. So that sort of it does counteract the PMI demand, but the PMI demand really is the one we really want to watch out for. But if we saw these continue to go down, for example, and we saw copper coming down, and we saw shipping costs starting to rise, that confluence of indicators would spell really big problems. However, we're not seeing that. And so finally then, unemployment, I'll just take a quick look at that. So this is US, this is again the Federal Reserve database. Again, we're seeing the permanent job losses, which is the more important measure really, since that's starting to tick up here. One to watch is November 2022. So if that continues up, again, that's bad. That spells problems for the US. And moving along, the unemployment level, which is slightly different, is kind of on an even keel. So again, unless we see unemployment really ticking up, then we won't see the recession. You can't have a recession without job losses. As we see here, it's 2020, problems caused by COVID. As long as this unemployment level remains relatively low, then recession will be kind of delayed. So only when we see this ticking up, that we sort of really again need to be concerned that we're heading for any kind of a recession or financial crisis. So we are not kind of there yet, or not there in the US. Out and elsewhere, as we'll see, the UK is kind of the same. So again, for the money that we might have deployed in our global funds, this is a reason for cheer. This is a reason for not panicking and not taking money out of the funds until we see this, something like this or this or this. Then I might sort of think more about reducing risk in equities. So which one is this? So this is in the UK, the ONS data, where this is the claimant count. Again, it's not spiking up, relatively even, although it's higher than it was before the pandemic. Slight warning sign, but if we see that heading up, then again, that might start to indicate problems in the UK. And the US, like the labour force participation rate, this is starting from 61.8 and going. So this is starting from a high base. It's only going down at sort of 0.1% per month. So everything's kind of fine in terms of employment in the US. And in the UK, the unemployment rate is ticked up slightly here, 3.6% in July to September, but you need to watch out for that because, like I said, this is a pandemic, so this chart you maybe can't see, if it ticks up to say like 5%, then that could spell problems for the UK. So yeah, it's just a case of being vigilant and seeing what direction the unemployment figures go, because it's only when we see that tick up that we sort of really want to start kind of like being more concerned. But at the moment in the UK and US, we're not seeing it. So there's no reason to really sort of panic as yet. So thanks for listening. And if you liked the video, please like and subscribe. And I'll see you in the next video.